way stronger than expected on the headline here, fourth quarter GDP. What would really be behind this? And what does it tell us, essentially, about what the key drivers are? And does it say anything about looking forward, as, of course, these are numbers in the rear view mirror?
Okay, so we were looking at 3.5. So yes, 4% is stronger than expected. It looks like it's coming from the industrial production side and that fixed asset investment. Though I suppose the retail sales numbers are still quite telling that the zero COVID policy is actually still weighing on consumers. We haven't been seeing that recovery that we've been seeing in the industrial sector. Going forward, we think that we are still going to see fairly weak growth. I mean, even at 4%, this is still a very sort of a weak number overall compared to history. And in the first half, we're looking for growth to continue to be weighed down, in particular by the property sector, and of course this zero COVID policy that China is going to continue with.
Yeah, just taking in retail sales, and my mistake there saying that everything was stronger, because certainly December was a big miss. Looking at that, what does that say about dual circulation, and how does that tie in also with those import numbers that we had last week in the trade data?
Okay, so the import data actually does still really point that domestic demand remains very sluggish. We did see on sequential terms that exports actually did pick up a little bit from Q3, but Q4 import numbers were still fairly sluggish. And that is really reflecting that the consumer side and, of course, the demand for commodities in terms of for the real estate sector are being weighed down by the sort of slow recovery in consumers. Going forward, I mean, as I said, we don't really think that we're going to see much in the first half. We should start to see a recovery in the second half. That's primarily going to reflect that we are seeing this easing in macro policies. Particularly, we're expecting the fiscal side to become a lot more supportive in terms of infrastructure spending. But obviously, we just saw that interest rate cut today as well. So we are seeing that sort of macro, the monetary policy easing, which should support at least, a bit of a recovery in the property sector in the second half.
Well, that's right. More important than the GDP data, it is that rate cut, pretty unexpected, 10 basis point cut, the first one since May 2020. Sian, I'm wondering, the intention is to be ahead of the slowdown. Is that enough?
I think it's going to take a little while. We do know that it usually takes a couple of quarters for actually the transmission from the sort of the macro easing to actually feed through. We do expect that credit to GDP growth will improve, so we will get a better credit impulse this year than what we saw last year. It's going to be a bit of a volatile year. I think the fact is that because of this zero COVID tolerance policy that they have in place, it does mean that the economic outlook, particularly for consumers, is going to continue to be weighed down about what kind of lockdowns we see. We see it less on activity on production. We've been seeing that during the year, that the disruptions are less on that export side and industrial side. But really, this recovery in consumer spending has been just very much lagging. It hasn't really returned back to the pre-pandemic levels yet.
How comfortable is the PBOC with the yuan at the current level? We know that there was intervention on Friday. Do you expect more? And can it do more, considering that, the U.S. may just cry foul?
Yeah, so we're looking for them to continue with their bias to stability. Now, obviously, with the fact that we have China easing monetary policy, we have the US, expected 4 interest rate hikes. It does all sort of point that at least on that terms of interest rate differential, that there's going to be some depreciation pressure. So, we actually think that though they're going to maintain sort of that stability. So they don't actually want to see, a big depreciation on the same front. They also don't want to see any kind of appreciation. So that's really the focus that we expect the PBOC to continue with.
Well, at the moment, Sian, we've got the National Bureau of Statistics talking. They're also talking about what's going on with birth rates. Now, what we have at the moment is the 2021 number of newborns, 10.6 million. That means the number of births per 1,000 people has fallen to 7.5%. Now, this is highlighting, surely, the challenge that China faces in terms of its demographic, as some would say, time bomb.
Absolutely. I mean, demographically, China's working population is slowing. It's still a very large working population, of course, but it is slowing, and that is a drag on sort of the long-term growth prospects. With that, we obviously have been seeing that China's very much focusing on improving their technology, improving their productivity. So, we expect that to continue to be the main thrust of policy for long-term growth, to try and offset this demographic challenge that China is facing.
Sian, are we expecting that contagion from the property sector? We know that Country Garden, which is among the better quality property developers, is now under pressure, perhaps unable to raise funds. How will that weigh on the economy going forward?
Yeah, I mean, the property downturn is, obviously a big risk. It's a risk that authorities are quite aware of. I mean, they have highlighted that it's housing is for living, though. It's not for speculation. So we're not expecting any kind of great sort of support going forward. But within that, we have seen some easing in terms of, encouraging banks to lend to mortgages and to developers. We've also seen some local governments cities actually try and ease some of those restrictions. It is quite important because obviously it's got a wealth effect for consumers. It's also important for, how local governments actually raise revenues to fund infrastructure, and it does have, linkages within the sector. So it's going to be something that the government's going to authorities are going to continue to be looking at, but we don't expect that there's going to be any kind of great easing, which probably means that we will see some defaults and continue with that sort of 3 red lines.
Yeah, and Sian, with all that in mind, we do, of course, see that the local governments are affected, banks are affected. I mean, is it really, really realistic to suggest this is going to all be ring-fenced? It's got to have wider implications for the macroeconomy, surely.
Well, I mean, within sort of our outlook, we do actually expect that, we're going to see that coal, steel production is going to slow. And that is actually part of the ramifications, that linkages with the real estate sector. So that's actually already embedded in our baseline forecast. But just given the importance of what it means, to the economy and those linkages, I think it's something that authorities are quite aware of, and they will step in. And they do have sort of that firepower to actually step in when needed to encourage sort of greater credit growth into those sectors. But they do not want this to become something speculative. They want to maintain, that sort of leveraging. It's just not going to be one of deleveraging that they're pushing through in 2021.